because I think this is not a terribly big class. So I'm hoping that I'll get your names, in my system here, hopefully in a reasonable amount of time. All right. So continuing from where we left off at boot camp, what we now have to do is the typical accountant's way of recording transactions. And the accountant's way of recording transactions is through a system called debit and credit. And the debit credit system was actually discovered by or first explained, in a journal of mathematics by an Italian priest. Okay, so this has been around for hundreds of years, and nobody has been able to touch it. So when you hear the word things like T accounts, they are all an offshoot of the debit credit system. So you don't have T accounts unless you have a debit credit system. So now the question is, how do we understand debits and credits from where we are right now? And actually, there is a pretty easy way to understand debits and credits. It is not terribly difficult. Debits and credits are understood by, okay, so let's first so if you take a typical, what I would call as a typical T account, so we put a T behind it, under it, and let us say you have an account called cash. Okay? So cash is a classic example of a T account. The left side of the T is the debit side, and the right side of the T is the credit side. This is for every T account. It doesn't matter what it is. Every T account has a debit side and a credit side, and the left side of the T is always debit, and the right side is always credit. Okay. So now the question is, if you have a transaction, how are we going to record it? Meaning that, where are we going to put it? Are we going to put it on this side or on this side? So the rule for that is very simple. The only thing you got to remember is two things. Number one, increase or decrease to assets, liabilities, and owner's equity. That's the first impact that you should know. If you have a transaction, what is the effect of the transaction on total assets, total liabilities, and total owner's equity? That's what we did the whole of the boot camp. We recorded it as a plus and the minus in individual accounts in these three categories. The second question that you want to ask is that which specific account is involved? Well, you may have an increase to the total assets, but you still have to locate the account which is making that increase happen. So, for example, you could have an increase to a total assets coming because you purchased equipment. So now the equipment account is involved. That you could have an increase to total assets because customers pay cash. So now your cash account is involved. Okay, you could have an increase to total assets because you bought inventory. So inventory is causing total assets to go up. So not only do you have to know whether there is an increase, decrease to the asset, liability, owner's equity category, you also need to know exactly which specific account is causing that. Once you have both this information in place for every transaction that you have, then the debit credit system is extremely easy. Okay. So the rule is what I have displayed here, and you can pull it up from the same file that I've been using for bootcamp. The rule is only the first line is what you have to remember. Everybody knows this equation, right? We know that assets equals liabilities plus owner's equity. We know this equation. So the only rule you have to remember in that table is the first line, which says that if an asset account increases, or if an account makes the total asset go up, put the money on the debit side of that account. That's the only thing you got to remember. Everything else follows logically. Okay? So if a specific account makes total assets go up because of that transaction, then record that transaction on the debit side of that account. Okay? So now everything else follows. So if it makes total assets go down, you record it on the credit side. That's logical. Then for the liabilities and owner's equity, you go the opposite. If a specific account makes liabilities go up because it's on the right side of the equation, go the opposite way. Then you record it on the credit side of that account. If a specific account makes liabilities go down, then you record the amount on the debit side of that account. Not all of that. I was talking about assets and liabilities. If the asset, no, it goes on the credit side. It goes on the credit side.
What did you just say after the second one?
If it goes down, you go put it on the debit side.
If total assets go up, it goes on the debit side.
That's it. That's the only thing you have to remember.
And the credit side?
That assets go down. So it's
like the liability part
on the table. If the table, in the table, the only thing you got to remember is the very first, entry on the table, which says asset and debit. Those are the only two things you need to know. Everything else is logically an offshoot of that.
What you said about the liability, I'm sorry?
The liability is, if the
Well, if it
liability
increases,
increases, you credit the liability account, and if it decreases, debit the liability account. Right? So that is a simple, rule for your, debits and credits. And then we can follow through on that. So let's take a few examples, and then we'll see for ourselves where we go. And I'm not going to, go back and forth on the same file, but I'll just do it on the board, and you can follow with the file. Okay? So let me pull up just the examples here on the board. All right. So it says the first transaction says, and I'll start from here. The first transaction says that billings to the clients for services provided was $350,000. We already identified in the previous sessions, we already identified what are the accounts that were involved here. The accounts that were involved here are accounts receivables and revenues. Right? This was accounts receivables as well as revenues at the same time. So now accounts receivables is going up because of this, correct? So then our rule says that if an asset account goes up, if a specific account in the asset category makes the total asset category go up, you record it on the debit side of that account. So what we will do is we will open an account called accounts receivables. Put a T below that. We will open another account called revenues. Put a T below that. These are specific accounts now in the different categories. There are 3 categories, and under each category you have specific accounts. So asset category account in this transaction is accounts receivables. So in the first transaction, what we will have, we will record the $350,000 on the debit side. This is the debit side. We just call it DR for whatever reason, but we just call it DR. Okay. And this is the credit side, CR. And remember, for every T, the left side is always debit, the right side is always credit, no matter what account it is. Asset, liability, owner's equity, doesn't matter. For every T account, the left side of the T is the debit side, the right side is the credit side.
Yes, yes.
So what we do, we record the 350 on the debit side, and the revenue, because now think carefully about the revenue. When revenue goes up, what happens to owner's equity? It goes up, right? It goes up. Why? Because profits go up. When revenue increases, profits increase, and when profits increase, retained earnings increases, and therefore your total owner's equity also increases. So revenue has the effect of increasing owner's equity. So since our rule says, I may have to keep going back and forth on the rule. So since our rule says that as for owner's equity, well, I kind of split up the owner's equity too, so it's easy for you to know this. If you take revenues, so when revenues increase, that makes owner's equity go down, right? That makes owner's equity go up, so you put it on the credit side. So therefore, what we will do here is that we will record this transaction on the credit side of the revenue account. So the first here would be 350,000. Now, the second transaction was what? Collecting 260 from customers, right?
Correct.
Right. So when you collect 260 from customers, what did we say? Well, we
Decrease.
had cash involved now.
You have revenues?
I'm sorry?
You have
This is
revenue?
No, when you collect the money, that's not revenue.
No?
The revenue happened when you build them. When you
Ah.
collect the money, it is simply a movement
always
of
have that.
amount from receivables to cash. What was receivable became cash when they paid up. Okay? So therefore, what did we say? We said cash goes up by 260 in the table. So we said cash goes up by 260, and at the same time, receivables goes down by 260.
Yes, yes.
Right? So now think about this. Just pause and think about this. At this point, if you look at the receivables account, how much is the balance in that account?
Zero? $90,000.
How can it
$90,000.
be zero? See, you have 350 on one side, 260 on the other. So now, at this point, if somebody asks you, how much money is due from customers to this company, you can immediately look at the debit side of 350, that's what is due. 260 was paid up, so therefore what is still due is 350 minus 260, or $90,000. That's what is called as the normal balance in this account. Typically, accounts receivable should show a debit balance because typically what is due will be more than what gets collected. Obviously, you're not going to collect more than what they owe you. So therefore, when you collect the money, it is typically less than what they initially owed you. So that's why we call this the normal balance. If you look at the cash account, if somebody asks you, how much cash do you have on hand right now? You can look at the cash account, look at the balance here as 260.
Yes.
That's the amount of cash you have right now. And how much revenues have you earned at this point? You can say $350,000. That's the balance in the revenue account. Now the third transaction was what? Buying equipment
Yes, for $50,000.
for $50,000. So now we said that when you buy equipment for $50,000, okay, so we said there is an equipment account. So I put an equipment account, put a P below that, and remember the left side is always a debit, the right side is a credit. Now I bought equipment for $50,000, and we said what equipment goes up and assets go up. So you record it on the debit side. So $50,000, so that is number 3. So 3 will put $50,000 in the equipment account. And at the same time, we said cash goes down by 50.
Yeah.
So when the assets go down, you credit it. So we put the 50,000, number 3, on the credit side. Okay. Everything okay so far?
Yes, sir.
Sorry?
Yes.
Yes?
Yes, sir.
That is number 3. Number 4 is what? Owners contributed money?
Cash investment, the owner's cash investment in the division of $600,000.
$600,000. So now, when owners contribute $600,000, what did we say? We said cash goes up by 600. So we are going to record this on the debit side of cash. And we said that now you have something called capital stock. Okay? So or share capital, or capital stock. And what does that do? That also increases, but that's owner's equity. So when owner's equity goes up, you put it on the credit side. Okay, like in the case of liabilities. So open an account called capital stock account. And put for number 4, you put $600,000 on the credit side of that account. Okay. Now watch here. Every transaction, what have we done? Whatever we put on the debit side, we put an exactly equal amount on the credit side. That's exactly the way we recorded it on that big tabular format. So whatever happened on the asset side, the same thing must happen on the liabilities and owner's equity side. Every line was in balance. To the left of the line, if you had a plus, a net plus on the left of the line, you had the same net plus on the right of the line. To the right of assets. So the total effect on assets must be exactly matched by the total effects on liabilities and equity. And an exactly same thing we are doing here, except that we use T accounts for that purpose. So what we now say is that every transaction should be in balance in the sense that all the debits due to that transaction must be equal to all the credits due to that transaction. And that's what we've been doing every time. Okay, just think about this, and I'll reinforce it a couple of times. Okay, so after the investment, so what did we have? What, inventory?
We had laboratory supplies, inventory,
Yeah.
purchase for cash of $150,000.
$150,000. So we said, okay, when you buy inventory for cash, we said two things happen. One asset account called inventory goes up, and another asset account called cash goes down. So what we do, since we don't have an account for inventory, we open it. So we have, or we'll call it some, we can call it inventory. That's fine. So we can call it inventory. So inventory account goes up by 150,000. That's number 5. 150,000. So we record it on the debit side, and we bought it for what? Cash.
Cash.
So you bought it for cash. Number 5, $150,000. Why? Because cash is going down. You record it on the credit side.
Is there ever a scenario where you would debit or credit to two different accounts and like split the amount? Or is it always gonna be like two accounts or 4?
No. It could be 3.
It could be 3.
It could be 3. It could be 4. It could be 5. It could be multiple accounts on the same thing. Just remember that total debits must be equal to total credits. If you operate 3 accounts, and let's say you debited 2 of those and credited the third, well, you obviously cannot debit all 3. You cannot credit all 3. So there has to be a 2-1 split. But whichever side is getting debited, the total of all the debits must be equal to whichever account is getting credited, whatever is it. That rule cannot be violated. I'll give you an example of how 3 accounts will be operated. Okay, here, let me take an example of that. This might actually work. Supposing, no, I'm just thinking on my feet now, so I have to be careful. Okay, supposing you bought the same equipment. Okay, supposing you bought the same equipment, $50,000 equipment. Okay, maybe that's a good question. I think this might clarify things out. Okay. Supposing equipment bought for $50,000, okay, on which $10,000 were paid in cash and $40,000 is owed. Correct? Supposing this is the transaction. That's very normal. Okay, it can happen very easily. So now what do we do? Here we have 3 accounts involved. What are the accounts? There's a liability account for equipment. Like say maybe accounts payable for equipment or something like that. You want to make that clear because typically just leaving it accounts payable means inventory supply. So if you're buying an equipment and owing the money, you could just put the word equipment in there to make it distinct from the other accounts payable. So make it accounts payable equipment, okay? Then you have cash, because some cash was paid, and you have the equipment account, right? The equipment, the asset was purchased. So now what we do, we open the 3 accounts. The equipment account, we have the cash account, and we have the accounts payable equipment account. Now, our equipment was $50,000. So therefore, what we do, we put the $50,000 here on the equipment account. Now, $10,000 cash was paid. So we put $10,000 on the credit side of cash. Why? Because this asset went down, so you put it on the credit side. This asset went up by $50,000, so you put it on the debit side. Then the third is your accounts payable equipment. That's a liability that's also going up by $40,000. Put that on the credit side. So this is it. So you could have 3 accounts involved, maybe 4, sometimes even more. Lots of accounts can be involved. And you will see that when I do closing entries, you will see that lots of accounts are involved. So lots of accounts may be involved in the same transaction, but the point is, the only rule is that the total amount debited on that transaction must be equal to the total of all the credits in that transaction. Okay, good. Let's get back to our example. Okay, so we dealt with inventory, and what was the next one?
Cost of laboratory supplies used, $80,000.
$80,000. Okay, so we said that's an expense of $80,000, and at the same time, your inventory called lab supplies is going down by $80,000. Okay, that's why we recorded it on the table. I mean, my point is that my constantly referring back to the table is only because we have done the table. You don't need to do the table first and then go do the debit credit. They are actually two substitutes to each other. So either you go the tabular way or you go the debit credit way. The only reason I'm taking you back to the table every time is because we have spent 6 hours basically going through that tabular thing. So it will be helpful for you to relate to what we did there, and so this will sink in very easily. That's the only reason. Otherwise, they are actually substitutes. You don't do both. You do one or the other. All right. So we had, okay, all right. So the cost of lab supplies used, we called it cost of goods sold. So we open an account, since we don't have it, we open an account called cost of goods sold. So we have cost of goods sold. Or what did we call it? Cost of supplies used?
Laboratory supplies.
No, the on the income statement, what did we call it?
Laboratory supplies.
The specific name we gave for that.
Isn't it inventory?
No, on the income statement. Expenses. Wait, no, this is a different example. No, on our, okay, I'll put it up here. That's the one that you had from the book. Cost of supplies used. Sorry. We called it cost of supplies used, so let's follow the same logic here. So cost of supplies used. Cost of supplies used. That's an expense, and as the expense goes up, owner's equity, what happens to owner's equity? Goes down. Because revenues make owner's equity go up, so expenses must make it go down. So when an expense is incurred, the owner's equity goes down. What is our rule here when owner's equity goes down? You debit the expense account. So we put $80,000 on the debit side of cost of supplies used, which is transaction number 6. And at the same time, inventory is going down, so you put $80,000 on the credit side of inventory. To record the fact that that asset is decreasing because of this transaction. Right? Yeah.
So writing down your two correct, right? So what impacts owner's equity is the capital stock, the revenue, expenses, and the dividends?
Correct. That's correct.
And if any one of those, so if revenue is credited to the owner, and like, how is the relationship?
Owner's equity increases. See, the big column is increase decrease. The owner's equity will go up every time you have revenues. That is the reason why this credit and this credit are the same. Why? Because revenues have a positive effect on owner's equity.
So capital stock.
Capital stock also has a positive effect on owner's equity. So that's the reason why these two are credits. Expenses have a negative effect on owner's equity, meaning that when you incur expenses, your owner's equity goes down. And at the same time, dividends also have a negative effect on owner's equity. You're actually reducing owner's equity when you pay dividends to stockholders. That's the reason why these two are debit. Because the effect up there should be the increase. Okay? So Yeah, that's right, that's right. If your owner's equity increases, you will credit the account. Okay? Here, expenses and dividends go the opposite way, that's why you debit those two. Because expenses and dividends, they make the owner's equity go down, it's a decrease. Okay? That's why you debit those two accounts. Okay? Go the opposite for that. Okay, so inventory is credited $80,000. Alright, so let's take number 7.
Salaries and other expenses paid in cash, $150,000.
Okay, so we have, the next is an expense, so we'll call it the salaries expense. I can squeeze it in here. Salary expense, or salaries and other expenses, was number 7, $150,000. It's an expense that's making owner's equity actually go down, so you will debit the expense account, right? You will debit the expense account because it makes owner's equity go. What else?
How do you know when, from that example in inventory, how do you know when to put it in credit or debit? It's not on that.
The rule. If the inventory is going up, you debit the inventory account.
But
If
you don't
inventory
have
is going down, you credit the inventory account.
You don't have inventory up there.
But that's assets, right? Inventory is an asset account.
Okay.
You're right. So it is a specific asset account.
Okay.
When it goes up, the total assets go up. That's why you will debit that account.
So, okay, so it follows the same rule as, okay.
Like cash.
Okay.
Cash is a specific asset account.
Okay.
If cash goes up, your total assets are going up.
Okay.
That's the reason we will debit the cash account. See, the problem is, you don't have an account called assets. You have specific accounts within assets. To say that, okay, this account made the total assets go up or down. So the recording cannot happen in a total assets account, it has to happen in those specific
Individual.
accounts,
Okay.
individual accounts.
Oh, and the
But
same
the
thing for
individual
equipment.
accounts are related to a category.
Okay.
Every category has got individual accounts. Liabilities have individual accounts, and an account cannot be in multiple categories.
Okay.
An account either belongs to assets, liabilities, or owner's equity,
Okay, I got you.
right?
And the same thing would go for equipment because it's an asset. Okay.
Very good. Very good. Yes, sir.
For the salaries, expenses,
Uh-huh.
so that if it decreases, you have to credit account, not debit it, right?
Yeah, usually an expense decreasing is typically not a transaction. Typically it is a correction of a mistake. Sometimes what happens is that you record the expense. Say here in this case, 150,000 was the salaries and expenses paid, right?
Right.
Suppose you record it as 180,000 by mistake. That'll be fine. You would have recorded $180,000 in expenses and you would have recorded 180,000 in cash. Then suddenly, like 2 days later, you discovered that transaction was wrong. It was not 180, it was only 150. So you got to bring it down to 150. At that time, the expense has to be reduced, so it's a $30,000 credit. So typically, there will not be a new transaction that makes expenses go down. Mostly, it is a fixing of a mistake that happened earlier.
No, I'm saying you put the 150,000 on the debit side, not
Yes.
on the credit side.
Why not on the credit side? Is that what you're asking me?
Yeah.
Well, the reason we do that is because, okay, here's an expense. We put it on the debit side, right?
Yeah.
Okay. Forget the debit side now. We'll try to get to that answer. When expenses go up, what happens to owner's equity? Goes down. What's the rule for owner's equity when it goes down?
But I know you have to address each one in the table specifically, not interrelated.
That's right. But here is a specific account that is making the total owner's equity go down. So therefore, this account must get a debit effect.
I guess the
Okay.
confusing part is
Yeah.
that expenses it's the opposite
Of the.
owner's equity.
Exactly.
So how
Yes.
do
So
you
you have
differentiate?
owner's equity, the rule for owner's equity, and then you have the rule for expenses.
Yes.
So how do you differentiate?
Well, because expenses have a negative relationship to owner's equity. When expenses, so look, if the rule for owner's equity says, okay, when owner's equity goes up, you credit, and goes down, you debit, right? You understand that rule?
Right.
Okay. So the rule for expenses should be the opposite of that. Why? Because when expenses go up, owner's equity goes down.
Right.
So expenses going up and owner's equity going down are exactly the same. So you cannot have different rules there.
Okay, so everything that you have there under owner's equity, if there's an effect in each of them, you have to treat the rule as owner's equity, not the specific one, right?
No, we have to do a specific one because that's why we are recording.
No,
But-
but
No.
I understand what he's saying, because there's two different rules for revenue, for expenses and owner's equity, and expenses, you debiting
You have
expenses
it
here
labeled
instead
as
of
an
crediting.
expense, so how are we supposed to know? which
Yeah,
So
which
for
one to
instance,
put in?
let me give an example.
It's
Okay,
not two different
okay,
accounts,
Like
it's
if
one
you give
account.
dividends, right? That's reducing owner's equity,
Correct.
right? So, but you don't take the rule for the dividends, which is that if the dividends are increasing, then you debit it. You have to apply the rule to owner's equity, right? Okay.
So the point, yeah, okay, fine. I think we're both saying the same thing.
Okay.
You should, I always learned that the hard way. There is a time when I should stop talking because you already got the point, and the more I talk, the more I confuse you.
Yeah.
So you're right. You're absolutely right.
True.
I recognize that.
So what is the other account? What is the other account for salary expense?
Yeah, we'll get that.
Okay.
So this was paid in what? Cash, right? So the other account has to be cash. So we put for 7, 150,000 credit side.
Eight? You're eight? Go ahead.
You all with me so far?
I'm not
Yes,
gonna
no?
get on it. I'm
What is
recording.
8?
Come on. Hurry.
Salary for December 2011 to be paid in January 2012.
Okay, you tell
I
me.
have a break like at 10.
Tell me what I should do for 8.
Come on.
What account should I debit? What account should I credit? And how much?
Account payable?
Salary,
Don't look at my solution. It's already there in that paper.
salary,
Without looking, just tell me.
What do you want?
Salary
you're
for
gonna do one for
Dividends.
salaries
Yes.
to be paid in January 2012.
What should be,
Big
okay,
one.
so this is
Account
what I
payable
want.
and salary.
Go
So
on
what
trips
account
when
to
you
debit,
want to.
You're gonna do an expense,
what account to credit, and how much payment.
you're gonna debit 10,000, right?
Okay, the amount is fixed. Everybody understand that the amount involved is 10,000?
Yes.
Okay. So now, which account is debited, which account is credited?
Salary.
Salary expenses and account payable.
What salary?
Can you open an account for the following year?
You can't. This is transaction for the current year, remember. For 2011, the salary expenses have been incurred. But they will be paid only in 2012.
So that, you're gonna open an
So you
account.
credit salary expenses?
We what?
You credit salary expenses?
Why?
Because of the effect on owner's equity decreases.
If owner's equity decreases, what should you do?
I'm sorry, debit, yeah.
Good. So you always have a 50% chance of being right.
No, I just looked at it.
But that's good.
Yeah.
What you did was exactly the way you do it. You got to talk it out, and if it is not logical, you got to go the opposite way, convince yourself that that is logical, and then move on. What she did was absolutely the way to go with accounting. This is the only way I learned it, and I can tell you it works. If I can turn around and teach this class, it obviously works. So it's this is really hard stuff initially, but it's not hard because the material itself is tough. It's because of all the jargon that everybody gets thrown at all the time. So that's the way to go. So let's go to 8.
10,000.
$10,000, right?
Right.
Okay. So we got $10,000 on salaries expenses, and what do we credit?
Account payable.
Something like a payable. Perfect. Very good. Very good. But on the big chart, what did we do? Go and look at the big chart. How did we record this transaction on the big, the tabular
We
thing?
did it as, we attracted liability, other liabilities.
Other liabilities.
Salaries payable.
Other liabilities was salaries payable, but since we use the term other liabilities, let's use the same thing. So we open an account called other liabilities.
Can we just do liability?
You open an account called other liabilities, and what do you do there? You credit, because that is going up. So therefore, what we have, this is number 8, 10,000. Excellent. Okay, so Since you're on a roll, do 9 too.
We
So
paid
what do we do
cash-
for 9?
We paid cash dividends of $20,000.
Okay, so what do we do?
Since owner's equity went down, because we're paying out dividends,
So we debit it.
we're gonna debit it.
Debit an account called dividends. So what we do, since we don't have an account called dividends, we're gonna open it. That's the other rule in accounting. When in doubt, open an account. When you're not sure, put it in a separate account. You can deal with it later. You can merge, you can do, but if you don't record it the first time in a way that makes sense, you will never be able to trace it. I mean, we are talking like hundreds of thousands of transactions in big companies. So if you don't pick the correct account initially, you can get lost in the maze. So that's why accountants have a rule saying that, okay, when in doubt, open it. By the way, I'm not an accountant. I don't know, I've probably told you this during boot camp. I'm not a CPA, I'm not a professional accountant at all. I have an undergraduate degree in mechanical engineering. Okay, so it's not, so I don't think like an accountant. Although with 30 years of teaching, I've started to think like an accountant now. Okay. But I didn't start off thinking like one. So it's, but again, one thing is, it makes perfect sense. When in doubt, open an account. Always. Because the initial recording has to be in as much detail as is necessary. And then later on, if it is too much detail, you can always merge. Okay? So therefore, so other liabilities are, okay, so we are in
Dividend?
9, right?
Yeah.
What was that?
We paid cash
Dividends.
Cash
dividends.
dividends. So we were looking at the dividends account, thank you.
Yes.
So the dividends is an account, put a T below that, and in 9, we will debit the dividends account because it makes owner's equity go down. How much is the amount? 20,000. So dividends is 20,000, so what's the other side?
Cash.
Cash, correct? So we have,
We credit.
we credit cash,
For the 20,000.
we credit cash.
Should have warned us that we're gonna need a lot of space on the payment. I have more space on my paper, Professor.
Yeah, other liabilities.
Yeah.
And other liabilities came from which transaction? Number 8.
Yes.
Alright.
Professor, can you go to the transaction?
Which one?
The last one.
The dividends?
Yeah, I'm reading dividends decrease.
No, dividends did not decrease. Dividends increase, so you debit.
Gotcha, you pay out.
Yeah, dividends has to be increased. So you debit it. The
Yeah.
reason you debit it is because when dividends increase, owner's equity goes down.
That makes sense.
Yeah. So you want to look at it this way. You want to look at this debit in relation to this debit for dividends. You want to look at this debit for expenses in relation to this debit for owner's equity, because these two are related. So when you debit the dividends account, it makes owner's equity go down. So therefore, it's the same thing as a debit here.
It's not for you.
When you debit the expense account, when you increase expenses, it has the same effect as decreasing owner's equity. So whatever rule happens here must happen here too. Because these two should be consistent, and these two should also be consistent.
Yeah.
Right? That's the reason. All right. So we have the other liability. So 9 is done. So 10.
And 2 years insurance.
Okay, so 10 says, okay, prepaid insurance, right? So we have prepaid insurance, we don't have an account for that. So let's open that. So we have prepaid insurance.
Open the accounts, yeah.
And that's an asset that's going up. So we have 50,000, this is what, number 10?
Yes.
Yes.
So 50,000 goes up, I mean prepaid insurance goes up by 50. And what happens is cash.
Go
Cash
down.
goes
Cash goes down.
Decrease.
This thing is, there's other liabilities that we can make up. Other liabilities, number 8. Okay, so 10 is done. So let's go to 11. 11 says, all right, laboratory supplies purchased on account. Okay, so if it is purchased on account, first we go to inventory. Number 11,
I mean, then,
how much is the amount? 65?
65.
So inventory is 65,000. And it was purchased on account, so it has to be accounts payable. Do we have accounts payable?
No.
no.
We have account.
No, we only have other liabilities, so we need to have accounts payable.
Yeah.
So let's open an account for
Allison, make
accounts
another,
payable.
make another account.
And we put 65,000 on the credit side, which is for 11, we put 65,000 on the credit side. Okay. Go to 12. 12 says paid supplier for laboratory supplies, $50,000. So now when you pay supplier, so 12 says accounts payable is going down, so you debit that account, 50,000. And since you're paying cash, cash goes down by 2.
Yes, yes. Easy. Look at him.
You credit cash $50,000.
If I can understand how to shoot himself.
That's number 12.
Don't pay attention to him.
Then we
Just
go
read
to
it.
13.
Read his confusion.
13 says charge the depreciation on equipment on a straight line basis. Our transaction says that we recorded a depreciation expense of how much? $10,000? So we say, since we don't have an account, so we open an account, depreciation expense. This is number 13 of $10,000. It's an expense going up, owner's equity goes down, so therefore debit. Yes.
I think maybe I just confused myself. So when you're saying depreciation, that's its own account. That has nothing to do with equipment. It's depreciation on the equipment, but we're gonna charge it to the depreciation account? It has nothing to do with the equipment. They're separate.
They're two separate things.
Okay.
This is of course an expense, so it has to be separate anyway.
Mm-hmm.
The other side to this is not also on the equipment, it goes into an account called accumulated depreciation. So rather than reduce the equipment account, we put it in an account called accumulated depreciation.
And that's just something you would know with experience, because
Yeah.
me initially reading that, I would think equipment. It says depreciation on
On the
equipment.
equipment,
Yes.
yeah.
But then depreciation, so the idea in saying depreciation on equipment is because the depreciation is charged due to having an equipment.
Okay.
See, you could have multiple assets that are getting depreciated. Equipment is one,
Mm.
building could be another,
Okay,
right? So it could be furniture and fixtures.
okay.
So lots of things could be getting depreciated, so it's better to have, you know,
Depreciation by itself.
to understand exactly what is it that you are depreciating.
Right.
So that's all.
Okay.
Okay, but it has to be a separate account called depreciation expenses. And then remember, we also had an account called accumulated depreciation on the asset side. So what happens when accumulated depreciation goes up? Assets go down. When you have more and more accumulated depreciation, remember it's a negative thing on the assets. So as accumulated depreciation increases, total assets are going down, so you will record this on the credit side of accumulated depreciation.
You're gonna give us that number?
Which number?
It's not in there.
It should be this thing.
Oh, it's in the transactions, but it's not in like number 13 itself, it just says.
Es lo mismo.
Oh, that's because when I gave you the transaction for the
Oh, no, pero
equipment,
tienes que
I
aprender.
gave you a life of the equipment
Claro,
and
que todo tiene
the
positivo
number
y
of years,
negativo.
the number of years,
No te confundas.
and the fact that it has zero value at the end of the year. So at this point, I will give it to you. But later on, when we do actual assets accounting, at that point, you will know how much to depreciate each year based on the rules. Any other questions? Any other questions? All right, so let's go to the last one, 14.
That's just the prepaid insurance.
Okay, so when you adjust prepaid insurance, remember we said we have an expense there, and at the same time, the prepaid insurance is going down. So what is the expense that we recognize? We recognize an expense called insurance expense. Since this is the last transaction, I'm going to squeeze it here. Insurance expense, and that will be debited because it's an expense that's going up. So number 14 will be 25,000 debit on the insurance expense, and the credit will go in prepaid insurance. Here it is, number 14, 25,000. Because the asset is going down, so you will credit the asset.
So quick question, so what we learned during the boot camp, this is basically the same thing but kind of different. So if we feel more comfortable with how we learned in the former class, we can stick with that
Absolutely.
method as opposed to.
Absolutely.
Oh.
But still, when you take your quizzes online, okay, the quizzes will require a few questions that may involve a debit credit system. So you need to understand the system. But from the point of view of the way I will test you in class, if I give you, say set of transactions and say, okay, how much was net income for the year based on these transactions, I don't care which way you go.
Only because I feel more comfortable in how I organize the information as opposed to this one. I feel there's a lot of different
All over the place.
and it doesn't lead you to one place.
Yeah.
Like the other.
Yeah, that's because I've been writing all over the place. It's really just in order to kind of, squeeze it all into one place. I've been using every bit of space on the board.
Okay.
So it's like, I'm messing you up too, in some sense.
So then basically what I was thinking of, you're able to go across the whole way and then the line items, you just have tables. Okay.
This kind of seems like a rough draft to put it in the chart that we learned initially in the boot camp. This kind of seems like, okay, this is a rough draft, and then I'm gonna put it neatly into the chart that we learned the first time.
It's because of me. This is not a rough draft. This is it. This is the way. Okay? It's just that I wanted to concentrate everything into one space so that it's visible to everybody. That is the reason why it is like this. Okay? It is not. This is the way. Accountants do it exactly this. Okay? They don't, there is no tabular
They do it on purpose. You want to keep $100,000, look how difficult this is.
You see, it's him.
Okay, the insurance is supposed to be used, and at the end of the year, money is required. So
Keep it simple. Don't pay
it's a transaction. We did that. We did that. See, look, if you have followed, folks, if you have followed the tabular transactions, then every amount that we have written here is already known. It's already there. There is no new amount here. And the accounts are also not new. I've used the exact same accounts that we had there. The only difference is that we use a debit credit system here as opposed to the tabular transactions where we did the plus and the minus. So we are just simply moving from a plus minus system to a debit credit system, except that it doesn't move that way. Plus doesn't go to debit and minus doesn't go to credit. The plus goes to debit based on what category it is, and the minus goes to a debit or a credit depending on what category. So that is the only thing you got to remember. So the new stuff that we learned today on the debit credit system, if the amounts are the same, the accounts are the same, the transactions are identical. The recording is different only because we used a debit credit rule to record the increases and the decreases to the asset liability and owner's equity categories due to separate accounts within those categories. Sorry, I'll give it to you. Yeah?
Since these two types of methods exist, what is the reason or the applicability of each type of method? Is there a specific reason why this one exists, and is there a specific reason why the other one exists?
I will tell you the other way around. This is for real.
That's the standard.
This is for real. And that is for MBAs.
Okay.
At some point in time, I think at some point in time, people who know a lot more than I do, they decided that you cannot teach debit credits to MBAs. I don't know why they made that decision. Because, all of us learned accounting only through debits and credits. That whole tabular system is totally new. But suddenly people said, oh, this is what happens. Like a whole group of people start to say, I hate debits and credits. Everybody starts screaming. And then suddenly everybody says, oh my God, students are upset with debits and credits, let's teach them differently. My point is that you don't say, okay, this is for real, this is the way accounting is done, you have to learn it. That's it. And you keep on working on it till you learn it. But that, with MBAs, we all make compromises, everybody, including me. So it's, that's what it is.
So shouldn't we learn the standard way?
Yeah.
Yeah, I'm sorry?
Shouldn't we learn the standard?
Well, let me just say that I am compliant with what my colleagues say. And the book itself, this book still persists with the debit credit system, but a lot of books have totally given it up and they have moved it to an appendix. It's really sad, yes.
Is it fair to say that only assets, when they increase, you put in debit, and when they decrease, you put in credit. Everything else is the opposite.
It's not everything else is opposite,
Right.
but that's because of the equation. Because everything else is on the right side and assets alone are on the left side. It is a logical offshoot of what you do in the first case.
So you can know what to debit.
No, because I'm just looking at this table here. If expenses and dividends are reliant on owner's equity, then everything else just shifts. So it's just the assets of debit and credit, and everything else is credit and debit.
If you really look guys.
I'm just trying to memorize it.
I know. See, that's my question. I was going to come to that. Guys, everybody, if you really want to memorize this stuff, okay, if you really want to memorize this stuff, then on the debit credit system, treat assets, dividends, and expenses the same. Okay, and then treat liabilities and owner's equity the same. Or liabilities and revenues the same. Because if you take out that one line called owner's equity, then you have all the details. So you can remember assets, dividends, and expenses, ADE. Assets, dividends, and expenses, they have the same rule.
Yeah.
When they increase debit, when they decrease credit. Okay, liabilities and revenues, when they increase credit, when they decrease debit.
Well, I want to say yes and no, because the expenses and dividends is relying on the owner's equity, like we
That's
did the
what I'm saying.
last time.
If you want to do the remembering thing,
Okay.
if you want to do the memory thing, forget that line called owner's equity.
Okay.
Forget that line owner's equity when you are talking about, see, the owner's equity has 1, 2, 3, 4.
Right.
That's why I say these 4, remember, if you take these 4 and the first 2, assets and liabilities, you can easily remember now.
Okay.
So you go assets, dividends, and expenses.
Expenses.
They all have the same rule.
Okay.
Liability, revenues, and the capital stock, contributions by owners.
Okay.
They have the same.
Okay.
But the logic is the equation. All right, folks. I think we need to make an exit, from the debit credit system soon. So. So let's look at the subsequent steps in this process. Okay, now we have recorded all this, right? Then what accountants do is that they come up with what is called as a trial balance. Okay, on the trial balance, I'm going to be careful. I'm going to be listing it, exactly.